What is up, guys? Forrest Knight here with the nightly news, back in my corner where all my dreams are built. My afro's a little bit bigger. Today I really wanted to chat about the EIDL loans, the amount of people who have applied for them, the amount that have been approved, and what that could indicate for real estate markets. So over here behind me you'll see a spreadsheet on my computer. Let's actually take a look here. So the EIDL website, actually they publish the amount of applications that have been out there, as well as the number of applications that have been approved, as well as the total amount. So my company, for example, we invest in Florida. If I look at the line item for Florida, I can see in April there were 110,000 applications approved, and then in May there was 297,000. There's a 187,000 increase in approvals, and the total amount borrowed just in Florida is 1.3 billion. Now, if you know how the EIDL loan works, it's a loan that the Small Business Association is granting out to businesses. The SBA already has disaster relief loans that existed, but there was a special program specifically for COVID. I think this is pretty important. It's something that people aren't really talking about, and how it can, what it means for the people that are applying for these loans. There isn't a one-to-one correlation by any means between real estate and the EIDL loan, but I do think that it means something. There is a massive influx of dollars from the government to people. We already know that, but there are some hard numbers out there, and they do vary by metropolitan area. If we take a peek at another market, say Illinois, 42,000 approvals in April, 101,000 approvals in May, and the total amount borrowed in Illinois as of May is $500 million. So a little bit less than half in Florida, obviously different populations, things like that. But there are any number of variables, etc., that can go into affecting these numbers. The way that I've been thinking about it and looking at it and really have been mulling around in my mind is that we have to realize that businesses are struggling, right? This is a massive amount of money that's being borrowed, which means that businesses are experiencing this hardship. These EIDL loans have a ton of strings attached, right? So people aren't just taking this money just because. They're really trying to stay in business, and they're doing whatever it takes to try to do that. So as real estate investors, knowing that, so the way that we as real estate investors make money is in healthy markets. We're able to raise rents. We can force appreciation by improving properties, and that ultimately raises the property value. So there's a number of different ways that we can do that, but it's hard for us to do that in a struggling economy. In general, there are always ways to make money, right? But in apartment syndication, it really does benefit us to be operating in a healthy environment, right? So when I look at the number of loans that are out there and what that can mean for myself as an apartment syndicator, my peers in this game, investors, you watching this video, is that you need to really think about the effects that small businesses have on their local markets. And if you're investing in those local markets, you probably need to understand what is happening to those small businesses. They employ tons of young people, college kids, maybe not even young people. That's what I'm familiar with, but there are all types of small businesses. They employ tons of people, and if everyone's not working at the small business, then they're just going to go and work at whatever super corp, less competition, suppresses wages. If people are making less money, then that means that we can't collect as much rent, which means we make as less money. So there's all these different dynamics that we have to keep in mind, and that's really just what I want to throw out there. I think that people in general, I'm seeing a huge amount of people in the real estate investment world who are just like, there's a ton of people unemployed, and people are borrowing a shit ton of money, but hey, I'm collecting my rent, so I don't think that's smart at all. I do think it's okay to look at the hard numbers that we have today and say, oh, okay, rent collections are good, better than we expected, and that's good. I mean, that's a good thing. It's undeniably a good thing. I'm not a pessimist. I'm not saying we got to run and hide and not invest. I just think that people need to consider these things. It's really the lack of consideration which is a problem, not the outcome. The observed outcome is like, yeah, that's easy, but it's like what new indicators are popping up, and what is that going to mean 3 months, 6 months, a year from now? Or on the other side of that, or another thing that I just saw today actually, is the mortgage delinquency rate doubled from 3% to 6%. It's not a massive number. It is massive in that the rate doubled, and again, it's very similar to the EIDL. People are struggling. I'm here in New York. There are a number of businesses that have closed down. The people that work for those businesses are going to be trying to find a job, and everyone else that's unemployed is as well. Those people are more than likely, if they're homeowners, probably not here in New York, but going to have trouble paying their rent. They're going to have trouble paying their mortgage. And that's just a problem that's just going to snowball and snowball and snowball. So a few people now, you're probably like, well, Forrest, if people aren't paying rent, or if they're not paying their mortgage, then maybe they'll sell their house and they'll go rent, and that's good for me. Maybe, but those are like second and third order consequences. It's good, but near term, that means that people are struggling right now. If you're not paying your mortgage for the house that you live in, times are tough. You're probably not spending in general. That means that consumer spending is down, like we know that it is, and this is just another indicator for that. So yeah, really the gist, and really why I wanted to put this video out there, is not to be pessimistic. It's really, I just think, it's always smart to invest. You should always be investing. You should always be looking at a way to update your game, play the game, make that money, build your wealth, build your family's wealth, and all of that. What's really been alarming me is that people haven't updated their game, right? It'd be like if you were trying to be a race car driver and you only ever drove when it was sunny out, and then on race day it's pouring rain, right? You still got to race, but the game has changed, and you're not going to be prepared if everybody else is, have practice driving in the rain. It's a very simple, stupid analogy, but you get my point. So that's really it. I'll link the spreadsheet. It's really just raw data. You can go look at it yourself on the EIDL website. That'll be down in the description. It'll just be a Google spreadsheet. And please, if you haven't yet, if you're watching this, like and subscribe so that YouTube knows I'm not bullshitting. Really trying to deliver some value to you guys. Force night out. Peace. Keep investing. Stay on it. Stay motivated. All that jazz.